If you have self-employment income, you have the opportunity to use some really powerful tools for retirement savings. So that might be the case if you're easing into retirement, maybe you have your own business, or you have a side gig. So for example, you could save up to $66,000 just in Roth, and I'll show you how to do that. Or if you prefer, you can do pre-tax savings and lower your taxable income for the year, pay a little bit less in taxes, and deal with the taxes later. So you have several options, but the question of what's the best retirement plan option for a self-employed person is going to depend on things like how much you want to save and what other features are important to you. So let's dive into some of those features. Before we get into this too much, we might be able to save you some time and energy. So if you want to save a relatively small amount, and when I say small, that's not meant to belittle anybody or criticize how much you're saving, but it's just that some accounts and programs allow you to save huge amounts, and some of them have restrictions that cap the amount at a much smaller level. If you want to save, let's say $6,500 or $7,500 per year, that's all you have the cash flow for, that's all you have the desire to save, then in that case, an IRA could be all you need. Those accounts are going to be the easiest to set up. You don't have to do an adoption agreement or figure out if you're supposed to use Form 5305 or something like that. Instead, you open an individual account and just start using it. Now, there can be some challenges, even if you just want to save, again, $6,500 or $7,500, there could be some challenges in terms of making that a deductible contribution or being eligible to contribute to Roth IRAs. For example, if your household income is too high, you might not be allowed to contribute to a Roth, and in that case, you may need to look toward an individual 401k, which would allow you to save in a Roth without those income issues. Likewise, if you prefer to make pre-tax deductible contributions to an IRA, you may have some issues based on your income and any other 401k plans, for example, that you have available to you. Again, that's where you may need to look toward a different option. So the IRA might be simple if that's your goal, and if not, we're going to look at these other options. So what we have here is a comparison of primarily a SEP or SEP, Simplified Employee Pension, and an individual 401k, also known as a solo 401k, UniK, or any other number of names depending on what vendors you use. The reason we're looking at these two is because when you look at the best retirement plan option for self-employed people, it usually comes down to these two options. That's because accountants often suggest a SEP, and you might be hearing about the SoloK and wondering if that's a decent alternative. Again, I'm going to lean toward the SoloK, but it's really important that you understand why and how these programs work. Let's start with the total annual limit of what you can put into the plan, and we'll look at tax year 2023 as we look at these figures. They will change from time to time as they adjust for inflation, so these numbers should only go up. The SEP will allow you to put in up to $66,000, and that's the same for a solo 401k. But if you happen to be age 50 or older in the calendar year you're contributing for, then a solo 401k would let you do an additional catch-up contribution of $7,500. When it comes to the employer contribution, also known as a profit-sharing contribution, the amount you can contribute to either one is roughly the same. The rules say you can deduct up to 25%, but for self-employed people, there's sort of a circular calculation that you have to go through, and it ultimately ends up being, let's call it 20%. I'm not going to get into that now. You and your accountant can figure out exactly why that's the case and what the exact number is going to be for you. But for today's purposes, let's go with 20% for either option. So that's a tie when you're comparing these two options, but the solo 401k does get a bit of an advantage when it comes to certain income levels. So if you make a relatively low amount, and again, it's not necessarily a small income, a lot of people would love to earn, let's say, $100,000. If you earn a relatively low amount, it's a lot easier to add more to a solo 401k than it is to add to a SEP. So with a SEP, you might be limited to, let's say, 20% of your earnings on a $100,000 salary. That would be $20,000. But with a solo 401k, you can easily put away $22,500 of salary deferral. There's no calculation necessary. That's just easy to do. You've got the right to do that. Then if you are over 50, you can put on that extra $7,500 as a catch-up contribution. So you're already ahead. And then on top of that, you can still do an additional employer profit sharing contribution. And we haven't even gotten to voluntary after-tax contributions, which you could also do in the individual 401k. So again, with the SEP, you're going to be capped at $20,000 in that example. With the solo 401k, you can easily get to $22,500 and then go quite a bit higher, again, quite easily. To keep things clear, the chart is now conveniently broken into employer and employee contributions. So below that black line, we're talking employee contributions. So again, a SEP doesn't offer any of those, but we're going to talk about 401k. The pre-tax contributions are allowed in a 401k if you want. So are Roth contributions. So you get to choose if you want to contribute on a pre-tax basis to reduce your taxable income, or if you want to make those Roth salary deferral contributions up to $22,500. That way you can potentially get tax-free income in retirement. That's, again, assuming you meet all of the IRS requirements. That's notable because you might remember in an IRA, you can only contribute, let's say, $6,500 or $7,500, depending on your age, to an IRA. But in your solo 401k, you can do up to $22,500 as Roth, plus your catch-up if you wanted. Or you can, mix and match that. So if you want to do half and half pre-tax and Roth, or 70% and 30%, or 30 and 70, whatever the case may be, you get to choose how you break that up between pre-tax and Roth. You also have the option in some plans to make voluntary after-tax contributions. We're going to talk more about that later in terms of getting that option available. But the voluntary after-tax contribution is money that you can choose to put in above and beyond those limits that we've already been talking about. I've got a visual example in just a second that's going to make that more clear. Let's talk about loans briefly. A 401k plan allows you to borrow against your account balance. You can borrow up to $50,000 or 50% of your account balance, whichever is less, and then you can repay that typically over 5 years. Generally, it's best to leave your retirement savings untouched, but this can be a way to get access to cash flow if you really need it. Now let's talk about deadlines. You can establish a SEP in the following year for the previous year. So for example, if you are filing your 2023 taxes and it's 2024, you could still establish a SEP in 2024 up to your tax filing deadline plus extensions. So that could be into the fall, depending on the type of entity you have. If you're a sole proprietor or you're incorporated, you want to check with your CPA on all of those details, but you can do it for the previous year. You can establish the plan and make contributions to it. The solo 401k used to have a hard deadline of December 31st for the year you want to contribute. So you would have been out of luck after December 31st of 2023 in the past, but the rules have changed in recent years, so you have a little bit more leeway. Here's how this works. If you want to make those employee contributions, you do still want to establish the plan before the end of the year you're contributing for. So that would be before the end of 2023 if you're trying to contribute for tax year 2023. But you can still establish an individual 401k, again, at your tax filing deadline plus extension. So that's into the fall of the following year, assuming you have timely filed extensions and meet all of the IRS rules. So definitely discuss all of this with your CPA or tax expert before you go for it. But you can potentially do all of this in the following year into the fall, even for a solo 401k, if you're just talking about the employer profit sharing contribution. So if you wait until after December 31st, You may not be able to make those employee contributions, the salary deferral contributions, but you should still be able to make those employer profit sharing contributions. That said, it is always best to do this well ahead of any deadlines. That way you can research and triple check the rules, which I strongly recommend you do. And that way you're not scrambling at the last minute. So here's a visual example. We talked about how could you put away $66,000, for example, potentially all to Roth, or this could be pre-tax. This is how your limit might work. Let's say you make $85,000 per year. So we've even lowered it from that $100,000. Again, this gives us the opportunity to save quite a bit more than a SEP would allow us to do, especially at this lower income. You could contribute $22,500 very easily of salary deferral, assuming you have the cash flow, but the limit is $66,000. So that leaves you $43,500 of room to do something with. One option is to make a profit sharing contribution. Now be aware that profit sharing contributions, or those employer contributions, are always going to be pre-tax contributions. So that's money that reduces your taxable income. It grows tax deferred. And then when you take it back out in retirement or later in life, that is when you owe the taxes on it. But if you don't necessarily want a tax deduction, you could instead, or in combination with that, you could make voluntary after-tax contributions. And that way you're adding even more money out of your pay, so you have to have the income to support that. We'll talk more about that in a couple of minutes. You could put more money into the plan out of your pay that you don't get a deduction for. It's also not technically Roth money right away, although you can quickly convert that to Roth fairly painlessly under current law. But you have up to $43,500 of room that you can fill up with profit sharing and or voluntary after-tax contributions. We'll talk more about the mechanics of that Roth piece in just a minute, but briefly, I'm Justin Pritchard, and I help people plan for retirement and invest for the future. And in the description below, you're going to find some resources on the topics we're talking about here, as well as some general retirement planning information. I think you'll find all of that helpful, so please be sure to check that out. And by the way, like I mentioned, it's just a friendly reminder that this can't possibly cover everything, and you really do need to speak with your own tax professional who is familiar with your situation, because the dollar amounts here can be big and they can cause a lot of problems when things don't go well. So let's finish up talking about that Roth piece, because you may be wondering how that works. This is what's known as a mega backdoor Roth strategy. And as you're trying to figure out what's the best retirement plan option and deciding between a SEP versus a solo 401k, this might be something that tips the scales, because it is only available in a 401k plan, and it works particularly well in an individual 401k, so not a company that has lots of employees. The way that would work is you make those voluntary after-tax contributions into the plan, and then you more or less immediately convert that money over to Roth. By converting immediately, there shouldn't really be much, if anything, in terms of earnings in that account, so the tax consequences should be negligible. You might have zero earnings, and then any subsequent growth, it's Roth money. So that potentially grows and comes out tax-free, again, assuming you meet all of the IRS requirements. To be able to do that mega backdoor Roth, you may need a custom plan document. So that is a piece of paper and some language and a trust setup that allows you to do those voluntary after-tax contributions with an in-plan conversion. So inside of the plan, you're making that conversion to Roth. Most of the off-the-shelf 401k plans don't allow that. For example, places like Vanguard, Fidelity, Schwab, all great providers, but they typically don't allow for this voluntary after-tax with an in-plan conversion as an option. As a result, you may need to go buy a document from a provider, and the cost is typically a couple $100, and you may need to pay a little bit each year as well for some help with administration, but it's typically negligible if you're the type of person who has the cash flow to make these big contributions. So getting back to this slide here, we talk about costs. The costs are typically similar between a SEP versus a solo 401k across most of the providers. you're going to maybe be paying a small amount, but it's only if you need to buy that custom document that a solo 401k gets a bit more expensive, and that's because you have more options. The costs are also going to depend on the types of things you invest in. So again, if you're working with those 3 names I mentioned earlier, you can choose from some low-cost index funds, but there are a lot of other investments out there and different vendors. Compensation is another piece that's important to understand. So in order to make contributions to these types of accounts, the money has to be subject to self-employment taxes. This can be especially troubling for people who have an S corporation because they might try to keep their W-2 wages as low as possible to minimize the amount of self-employment tax they pay. But if that pay is not subject to those payroll taxes, then it's not eligible for contributing to a 401k. And it's not something you can use in the calculations when you're looking at your profit sharing contributions. So you have to find a balance there in terms of how much you're paying yourself. Obviously, it also has to be reasonable compensation so that you're not running afoul of any IRS rules. Going back to our example, let's say you wanted to put away $66,000 in Roth using a mega backdoor Roth strategy. You would need to pay yourself at least that much in W-2 wages, or if you're a sole proprietor, you're going to need to have at least that much in profits on Schedule C. Your compensation can also top out eventually, so above $330,000, not many people making that much, but above that level, then that compensation is no longer even counted for these calculations. So that's something to think about if you're a high earner. In that case, you might be able to max out a SEP pretty easily pre-tax. And in that case, a 401k might not be that appealing to you, just something to keep in mind. Some good news is that these income limits that you might be used to with your IRAs do not apply to a 401k, for example. So again, if you earn a lot of money and you were not eligible to contribute to Roth, that's not the case with a 401k. You can set up your solo 401k and contribute a lot of money to Roth even with that high income. So what happens if you hire somebody? In that case, these things may change. So again, we're talking about the best retirement plans for self-employed people, but once you have employees, you may need to change your program altogether. And here's why. With a SEP, you typically contribute a percentage of your compensation, and every employee across the board would generally get that same percentage. So if you're contributing 20% of your pay, then any employee you hire is also eventually going to be eligible for 20% going to their SEP from your pocket. If you're feeling generous, that's excellent. It's a fantastic employee benefit. But a lot of people, especially when they're in the first starting to hire people phase, that's not something that's typically feasible for them. And it's similar with a solo 401k. You would no longer qualify for a solo 401k. And what that means is the individual 401k doesn't require testing, and it has some other ease of use features that don't apply to bigger 401ks. So you can have a spouse on the payroll and that person can participate in your plan, and that's a great way to maximize your contributions as long as they have legitimate employment in the same business. But once you hire somebody else, then you may need to switch to a more robust 401k. You're probably going to need to change plan documents or vendors because, again, those off-the-shelf products for 401ks are typically pretty simplified. Speaking of paperwork, how do things compare between a SEP versus a solo 401k? A SEP has a little bit of extra paperwork compared to an IRA, and then a solo 401k has even more paperwork. So you're typically going to do an adoption agreement to create the 401k plan, and then you as the participant or the person saving money in the plan have to do your own account application in many cases. So it's a couple of extra steps, but really pretty painless and something you do once. A 401k does have an additional requirement that if your balance is above $250,000 for a year, or when you terminate the plan, when you shut it down, basically, maybe you go out of business, you retire, whatever the case may be, then you have to file Form 5500 with the IRS. It's a pretty short form, but it is something that sometimes people aren't aware of or they just forget to do. Let's talk briefly about Simples. This is another IRA-based plan that allows you to save some money, and it's a decent amount of salary deferral that you're allowed for the year. It is all pre-tax, so if that's your main goal, you want to be somewhere between a traditional IRA and what you can do in a 401k. You could go with a simple. I don't see a lot of people doing that, and I'm not sure there's an advantage to that. And the reason is because, in part, a simple adds some restrictions. In particular, you're not allowed to have a simple and a 401k for the same year. So if you ever did want to start using a 401k, this is going to hold you back, and you might as well just go with the 401k if that's the direction you're heading in. And when it comes to investments, the options between a SEP versus an IRA versus a solo 401k are often the same, again, assuming you're using those main vendors that we talked about earlier, and assuming that you're not trying to get too fancy. If you're happy using mutual funds and ETFs, you're not going to have a hard time finding that. So if you are finding the 401k intriguing, be sure to watch this video that should be popping up. It's going to talk all about the 401k maximum, the different components that go into it, and especially how it works if you work for multiple employers and have multiple plans. So I hope you found this helpful. If you did, please leave a quick thumbs up. Thank you and take care.